Hey everyone, and welcome to this brand new YouTube explainer. I am absolutely thrilled you're tuning in today because we are going to literally rewire how you think about your bank account. Today, we're unpacking a truly unique and catchy summary of Morgan Housel's incredibly popular book, The Psychology of Money. If you've ever found yourself wondering why the whole world of finance just seems so baffling, or, why doing everything right on paper sometimes goes horribly wrong, well, you are in the exact right place.
Let me start off by asking you a seriously crazy question. Why do incredibly smart people, we're talking doctors, engineers, high-level executives, why do they so often go completely broke? Why do these brilliant minds, people who can literally solve complex calculus or build massive companies from scratch, fail so spectacularly at personal finance? It's this wild paradox that's been plaguing us for decades.
See, growing up, we're taught that money is basically just math, right? It's logic, it's formulas. We're trained to treat personal finance like it's physics, where you just plug your numbers into a spreadsheet and boom, it guarantees a perfect result. But the reality? Money is all about psychology, emotion, and history. Your financial success honestly doesn't have much to do with how smart you are. It's all about how you behave. And let me tell you, behavior is incredibly hard to teach, even to genuinely brilliant people. Okay, let's dive right in. Here is our roadmap for today. We're going to be unlocking 5 major paradoxes: the great money paradox, the math of luck, getting rich versus staying rich, the true value of wealth, and finally, the price of admission.
All right, Section 1, the Great Money Paradox.
So there's actually some incredible science behind this. Economists from the National Bureau of Economic Research did this massive study, and they found something totally fascinating. In theory, your financial decisions should be driven by your personal goals and whatever investment options are available today. But in reality, your entire financial worldview is firmly anchored by the economy of your early adulthood. Think about that. Your personal experiences make up only this tiny, microscopic fraction of what actually happens in the world, but they make up almost 100% of how you think the whole financial world works. If you happen to grow up during a time of crazy high inflation, or maybe a massive stock market boom, that highly specific, totally accidental slice of history dictates your risk tolerance for the rest of your life.
Which brings us nicely to Section 2, the math of luck.
66%. Just let that number sink in for a second. That is the average annual return rate of a legendary investor named James Simons, the guy who founded Renaissance Technologies. Getting 66% per year is almost unfathomable. To put that into perspective, Warren Buffett, who is pretty universally considered the greatest investor of all time, has only averaged about 22% annually. So Simons is basically beating Buffett by an absolute landslide when you look at pure percentages.
But here is what I call the compounding shock. Even though James Simons has that jaw-dropping 66% return, Warren Buffett is roughly 75% wealthier than him. How on earth is that mathematically possible? Well, it all comes down to time. Buffett didn't have the highest returns. He just had pretty good returns that he managed to maintain consistently for a very, very long time. He started investing 40 years earlier than Simons. In fact, if you look at the data, more than 97% of Warren Buffett's immense wealth was accumulated after his 65th birthday. The real secret wasn't some massive annual yield, it was the sheer unrelenting power of compounding interest over decades.
And all that extra time allows you to capture what we call tail events. Take a look at venture capital returns. Most of these investments just completely fail. Roughly 65% of VC investments lose money entirely. Another huge chunk just barely breaks even. But there's this microscopic sliver, literally just 1 or 2%, that returns 20 times the original investment or even more. And that tiny sliver drives the vast majority of the wealth. It's the exact same story in the stock market. Historically speaking, almost all of the market's overall returns are driven by just a tiny percentage of outlier companies.
This idea is perfectly captured by the story of Heinz Grumman. He was a man who fled Nazi Germany and eventually built up an art collection valued at over $1 billion. So how did he pull that off? Well, Horizon Research noted that he bought and sold thousands of pieces of art. And honestly, most of them were essentially worthless. But, as the saying goes, if a tiny percentage turn out to be literal Picassos and Matisses, they make up for all the ones that weren't. The absolutely crucial takeaway here is that you don't need to be right every single time, you just need to cast a really wide net, stay in the game long enough, and let those few big lucky tail events do all the heavy lifting.
Let's shift gears now to Section 3, getting rich versus staying rich.
This is a massive stumbling block for so many people because keeping your money requires a completely different personality type than making it in the first place. Getting wealthy, that requires taking big risks, stepping out on a limb, being relentlessly, almost blindly optimistic. But staying wealthy, that demands the exact opposite. It requires profound caution. It requires a really healthy dose of paranoia and a constant fear that whatever you've built could just be taken away tomorrow. This is exactly why 40% of companies that are successful enough to become publicly traded eventually lose all of their value. They keep that getting wealthy mindset and they completely ignore the staying wealthy reality.
To really understand why this paranoia is so necessary, check out this bizarre piece of history. During World War II, right outside of Stalingrad, a German unit had 104 heavily armored tanks just sitting in reserve. When they were finally needed for what became the largest battle in history, the officers went out there and discovered only 20 of the tanks actually worked. Why? Because during the weeks they were sitting idle, tiny field mice had nested inside them and completely eaten the electrical insulation right off the wires. I mean, think about it. No brilliant military engineer sits down and plans for a 20-gram mouse to completely disable a 25-ton steel war machine. But freak, unplannable events are always going to threaten your plans.
Which leads us to this incredibly crucial concept, margin of error. Surviving the metaphorical 20-gram mouse in your own financial life means you have to build the possible, and frankly, likely failure of your plans directly into the plans themselves. You have to have a margin of error. You achieve this by always holding cash reserves, never betting your entire livelihood on one single strategy, and above all else, never risking what you have and need for what you don't have and don't need.
This naturally flows into Section 4, the true value of wealth.
Back in 2009, the massive pop star Rihanna nearly went bankrupt. She lost 82% of her immense wealth in a single year. Naturally, she turned around and sued her financial advisor for mismanagement. But the advisor's legal response was absolutely brutal and honestly brilliant. He said, was it really necessary to tell her that if you spend money on things, you'll end up with the things and not the money? Ouch, right? We constantly imagine wealth as the luxury cars, the massive mansions, the designer clothes you can buy. But trying to look wealthy is literally the fastest way to destroy your actual wealth.
So here is Morgan Housel's golden rule, stated as plainly as possible. Wealth is the money that is not spent. Wealth is the invisible stuff. It's the sports cars you didn't purchase, the diamonds you didn't buy, the first-class upgrades you declined. Savings basically act like these massive, untapped energy reserves. It is way more effective to efficiently use the wealth you already have than it is to desperately hunt around for new sources of income just to fund a really flashy lifestyle.
Now, you might be sitting there wondering, well, what's the point of having it if I'm not going to spend it? Look at this fascinating 1981 happiness study by Angus Campbell. He really wanted to find out what actually makes human beings happy. And guess what? It wasn't their income level, it wasn't their education, or where they lived. The absolute highest predictor of human happiness was having control of your own time. The ultimate return on investment for saving your money isn't buying more stuff, it's buying the flexibility and the freedom to wake up every single day and do whatever you want, completely on your own terms.
Now for our final paradox today, Section 5, the price of admission. Think about investing like a really simple analogy. Say you want a $30,000 car. You generally have three options. Option 1, you step up and pay the $30,000. Option 2, you decide that's way too expensive, so you settle for a cheaper, used car. Or option 3, you can be foolish and try to steal it. Financial returns in the market work exactly the same way. The returns aren't free. You either pay the price, you settle for less, or you foolishly try to steal the returns by gaming the system. And what exactly is that price? 94%. Let me explain. From 2002 to 2018, Netflix delivered an absolutely unbelievable 35,000% long-term return for its investors. It was a massive, life-changing wealth generator. But the price of those returns? It was pure psychological torture. Because during that massive run, Netflix traded below its all-time high on 94% of the trading days. You literally had to endure endless days, weeks, and months of watching your portfolio sit below its peak just to get that final payoff.
And that brings us to this critical contrast. You have to start viewing market volatility, doubt, and all that uncertainty, not as a fine or a punishment, but as the fee for admission. You just have to pay the fee. Because if you refuse and you try to game the system to steal the returns without enduring the volatility, you end up like General Electric. Under Jack Welch, GE's finance division notoriously massaged their numbers to constantly hit targets and hide all their underlying risk. They desperately tried to avoid paying the fee. And the result?
Well, the system finally caught up with them in 2008, and their stock catastrophically collapsed from $40 a share down to $7. You simply cannot illegally or artificially bypass market realities.
So, as we wrap up this explainer today, I want to leave you with one final provocative question to think about. Are you willing to pay the fee of volatility to buy your ultimate financial freedom? Remember, true wealth is not just some math formula on a spreadsheet. It's a deeply psychological game. It's all about practicing extreme patience, maintaining a really healthy margin of paranoia, embracing the unseen, invisible value of saving, and most importantly, giving your money the time it actually needs to compound. Thank you so much for joining me on this deep dive into the psychology of money. I really hope this leaves you fired up and eager to put these counterintuitive secrets into action. Catch you next time.